The market is currently closed. The final closing price for Tesla stock on Friday, July 17, 2026 at 4 p.m. Eastern Time was exactly $380.84 per share, representing an intraday drop of $10.26 or 2.63% on a trading volume of over 31 million shares. While the headline numbers show a standard pre-earnings retracement, the underlying institutional flow tells a completely different story, as large block options activity indicates big money is silently hedging against a severe cash flow crunch, even as retail investors rush to buy the dip. The prevailing narrative across every major individual brokerage is that this company is a pure play on autonomous tech that will inevitably scale to infinite heights, keeping the valuation stretched at a staggering price-to-earnings multiple that hovers well above 350 times trailing earnings. This expectation has created a massive premium on the stock, forcing everyday retail buyers into using tools like the Robinhood app or looking for general investment help across various self-investing forums to justify holding a stock that trades more like a speculative software startup than a manufacturing powerhouse. The harsh reality, however, is that automotive operations still generate roughly 70% of the total revenue mix, meaning the physical infrastructure, factory floor efficiencies, and vehicle delivery metrics still completely dictate the baseline health of the company. When you pull back the curtain on the actual balance sheet, the heavy reliance on price cuts and aggressive buyer incentives to prop up unit volumes is actively eating away at operating margins. The market expects autonomous driving and artificial intelligence to step in and immediately subsidize the capital-heavy car business. But the reality is that physical infrastructure spending is accelerating at a pace that could lead to negative free cash flow over the next several quarters. Looking closely at the recent stock movement, the daily swings tell us a lot about current institutional positioning. Over the last month, the stock has been locked in a range-bound struggle right around the $400 psychological level, pulling back from its late last year peak near $498. Volume has stayed slightly below the 34 million daily average, showing that many institutional managers are keeping their hands under their desks until the upcoming quarterly report drops. On the Interactive Brokers trading desk, we are seeing a distinct rise in implied volatility, which means option premiums are spiking as traders prepare for a massive post-earnings move. If you track the order book across the main Interactive Brokers platform, the bid-ask spreads are tightening, but heavy block orders are sitting down at the $368 support level. A big reason for this caution is the massive divergence in analyst expectations. Some prominent Wall Street firms have recently come out and raised their quarterly adjusted earnings estimates to 69 cents per share, driven by a surprise beat in vehicle deliveries, which came in at over 480,000 units. Yet other major analysts are warning that sequential margins are bound to shrink because of rising raw material costs and a complete lack of one-time regulatory credits. This tug-of-war is putting massive technical pressure on the stock. To get any real upward momentum back toward the mid-400s, the price has to consistently close above its 200-day simple moving average, which is currently setting near $417. Right now, it is pinned below that line, showcasing that macro pressures, like sustained high interest rates, are making institutional investors highly critical of companies that trade on future promises rather than immediate hard cash generation. When evaluating where to allocate capital, many retail participants looking for online investment options often compare these fast-moving tech giants. They look at Apple stock or Nvidia stock and try to apply the same exact valuation framework to this automotive business. They log into their Fidelity brokerage accounts or browse through various investing sites, hoping to find a clear answer on whether to buy the automotive leader or stick to pure chip makers. But this business model is incredibly unique. The core framework relies on designing, manufacturing, and deploying high-performance electric vehicles while simultaneously building out an independent global sales and service network. In its early years, the business scaled rapidly because it had virtually no domestic competition in the premium electric vehicle space. It captured massive market share and used regulatory credits sold to traditional automakers to fund its early production expansions. However, the operational matrix has fundamentally shifted. The global landscape is now flooded with massive competitors, particularly out of Asia, where massive producers have overtaken this company in total volume and frequently challenge them in pure battery electric vehicle sales. Past reports from previous quarters showed massive net income spikes, but a lot of that historical performance was boosted by unique tax benefits and optimal supply chain conditions that no longer exist in today's macro environment. Comment below how many shares of Tesla stock you currently hold in your portfolio right now. As we look toward the future outlook, the tension between what the market expects and what reality will deliver is only going to widen. The bullish thesis relies almost entirely on physical AI, meaning the long-term monetization of full self-driving software, the global deployment of a dedicated robotaxi fleet, and the commercial scaling of human-like robotics. If you're managing your capital through tools like Schwab Intelligent Portfolios or utilizing an automated SoFi robo-advisor, these platforms usually look at past volatility and standard sector weights, but they cannot predict the sudden regulatory shifts that govern autonomous driving. The upside potential is massive if the company secures widespread regulatory approval for its self-driving software across Europe and North America, which would immediately allow them to generate high-margin software subscriptions. That scenario would completely validate the current valuation and send the stock surging back toward its all-time highs. On the downside, the risk is substantial if the core automotive margins continue to erode under the weight of heavy discounts. If capital expenditure stays at the $26 billion mark to build out massive data centers and the cash flow turns deeply negative, the stock could face a massive re-rating down to earth. Investors using a standard individual brokerage account need to realize that the current price target consensus sits right around $409, leaving very little margin for error. To wrap everything up, this stock remains one of the most polarizing assets in the modern market because the gap between narrative and numbers is so wide. The expectation is that the company is an untouchable technology monopoly that will easily fund its robotics future using its dominant position in the car market. The reality is that the car market has become an aggressive price war that is actively draining cash, leaving the future expansion heavily dependent on speculative tech milestones that are still years away from full commercialization. Whether you manage your assets through a Fidelity trading platform, execute quick trades on the SoFi trading platform, or hold long-term positions inside your Fidelity IRAs, understanding this expectation versus reality dynamic is the only way to navigate the upcoming volatility without getting caught on the wrong side of the trade. Disclaimer: